Now, as the impact of lower oil prices continue to be felt across the continent, Nigeria's finance minister recently announced plans to borrow up to $5 billion from multiple sources to plug the country's deficit. CNBC Africa's Wole Famurewa spoke to Edward Voelcker, an energy and natural resources partner at KPMG, to discuss how countries in Africa are reeling from the fall in crude oil prices.
Okay, Edward, thank you so much for joining us today. Of course, a good place to start if we're talking about the future of oil in Africa is maybe to get your thoughts as an advisor. What do you think? Where do you see oil going, given the dynamics we're seeing playing out in the Middle East?
That's a really tough one. Been in the industry 29 years, never want to get hung up on a particular oil price forecast. But if I could briefly take your viewers through sort of four brief components. Of course, we have U.S. production growth that led to a lot of it. Now, some of that may come off as the prices fall, and maybe some of those developments can't happen, so U.S. Production may fall. Then you have the Iranian issue with Iranian supply coming on. They are going to have new investors. That will probably bring more supply into the future. Then you have OPEC, which isn't really behaving like a cartel. Early December, they had a meeting where not much happened, really. That could change potentially if the cartel wants to behave like a cartel. Then finally, I think you have China. Again, a somewhat big unknown. They're trying to move more towards a service economy. Does that mean lower oil imports? A little bit hard to say.
It's always tough to call, I know.
In those four components, hard to predict.
It's likely to be down, and maybe down for a while, certainly relatively down. But your thoughts on the immediate impact? We're seeing that already, and recently we saw job cuts in the national oil company in Cote d'Ivoire. We're expecting a lot more. Your thoughts about how African countries are likely to react to this oil price impact?
I think it goes in sort of three components there. West Africa is certainly going to be heavily hit by it. Ghana, Nigeria, and Angola. We've seen in Angola the Kwanza fall similarly to the Naira. Nigeria, we know of the issues here. Ghana luckily has a new production coming on mid-year, third quarter this year, that was developed basically before most of the prices fell. So they will at least have some more production, which may help them a little bit, but at much lower prices. Then you have any country, of course, that simply doesn't produce oil but imports a lot of products. And there will be significant savings to countries that import petrol and jet fuel and diesel and things. So massive savings there. East Africa, you have these large projects in LNG in Mozambique and Tanzania, and then in oil in Uganda and Kenya. Those are probably stuck.
Wow, I really wanted to get into that. The impact of this on investment flows into the sector. Nigeria, we have seen very little investment. And the big question is what happens now that we are seeing sub-30 oil?
Right. Well, this is a fantastic time, of course, for the new government to decide what is the future of the PIB. We believe that's broadly shelved, and they have a new PIG idea about governance improvement and how to deal with the assets within MPC. I think if they can clarify that to investors, that's always a very, very good sign, because there will be people, even at $30 oil, who can find an investment in this country.
I think that is a big question. Can we still invest at sub-$30 oil? Because I think there's always been this question mark on how much exactly does it cost to extract oil. Your thoughts on the impact across Africa?
Certainly. Well, specific to Nigeria, the big thing that everybody needs to discuss is gas development. We really need so much more infrastructure for gas to cut down the flaring, to provide gas to the power plants that have already been built and are ready to generate for us. And then there are plans in the works with Alhaji Dangote to build a huge gas pipeline offshore. So if you look simply at the gas business, which is unrelated to the oil price fall in Nigeria, massive potential for investment in gas here in Nigeria specifically. Then can $30 oil produce more oil in Nigeria? Probably. Onshore in the shallow swamps and things, maybe a challenge. Deep water, almost certainly not.
But is it a bigger challenge outside the Gulf of Guinea? So we're looking at the rest of Africa.
I think definitely is East Africa. Those developments are not necessarily offshore. Their oil development is onshore, but the massive infrastructure cost of 1,300-kilometer pipeline, a new port, and things like that are going to really make $30 oil a huge challenge. Gas, again, Mozambique, Tanzania gas may go at this point in time, but that may need to be renegotiated with the government.
All right. there's always been this call for value addition. So to the oil industry across the continent, instead of just exporting crude, we need to start refining. And your thoughts about that, the government's rethinking their oil sector strategy in the context of what's going on in the globally?
Stakeholders, again, getting Nigerian content or local content in any investment right is always going to be a challenge. Luckily, at the $100 barrel mark, Nigeria made some very good progress, as did some other countries. I think, though, the expectations in some other countries that have not developed oil and gas yet for local content is very, very high. And when margins are tight, that is one of the large things that needs to be discussed with the government. There is the benefit from the entire project being developed. There is additional benefit from local content. But you have to weigh those two issues and look at it very, very carefully.
Well, if we take this conversation to perhaps improving intra-Africa trade, a lot of the refined products that are imported into Africa are not coming from Africa. So your thoughts about that opportunity? So for instance, Nigeria, perhaps refining for the rest of West Africa and perhaps even to, for the broader continent.
Absolutely, and should certainly happen. Again, Alhaji Dangote has a plan for an absolutely massive fertilizer, petrochemical, and refinery, hopefully online in the by the end of the decade or so. Would be excellent for West Africa and worldwide Africa trade. However, East Africa also has plans around a refinery, possibly one in Uganda, which may be landlocked, and then a Kenyan one at the Lamu port. Refineries are always very tough business, a very small margin business, but with the transport costs and the transport challenges in Africa, more functioning refinery capacity would be great. Then we do have to see, though, if the new management of NNPC here will get the 4 existing Nigerian refineries back up to some level of production, which would be the most immediate thing.
You just mentioned the NNPC, and I just want to get your thoughts about how government should begin to rethink the national oil companies. The NNPC, we are hearing about reforms going on there. People are asking for more, but your thoughts about how governments should begin to rethink the position of the national oil companies in this new oil price environment?
Well, some of the signs have been very good because it appears that many things are on the table. They are open to discussion in many different areas, which is great. For the Nigerian indigenous companies, which we haven't touched on too much, some of the Shell asset sale companies who bought assets from Shell, but where NPDC, part of NNPC, became the operator, they have floated the idea of turning those into IJVs, incorporated joint ventures, similar to the NLNG model. And that might be something that all stakeholders would benefit from. It would take some of the cash call issues off NNPC. It would allow the operations to potentially be more efficient and get on with the redeveloping those Shell fields. So all of those ideas should be discussed, but we have to get the right stakeholders at the table. As Nigeria learned from the PIB, if you don't have everybody at the table at the right time, or at least hearing their issues, you'll go very quickly in one direction and the brakes will get slammed down somewhere.
Right. For you, what's the future of indigenous oil companies, given all that has happened over the last 12 months? We did see that surge of interest from the locals, and maybe we began to talk about, especially in Nigeria, that we could get to a point where locals may be accounting for as much as 30 to 40% of production. Do you think that is still likely to happen, or do you think this new oil price environment, and of course many of the deals that have happened already, could stunt that growth?
More challenges. Can't firmly say, but I think we would almost guarantee some mergers or some alliances. So many of the Shell assets, as well as some Chevron assets, went to many different companies. And you effectively have 10 new companies now in Nigeria that all have a CEO and a board of directors and a COO and a drilling department and things like that. Possibly, we don't want to recreate Shell, but some mergers or some alliances for to lower the cost and be able to deal with this $30 challenge. And then, of course, the banks. Almost all of these companies are fairly heavily indebted, and the banks are going to have to be patient and work with the companies for efficiencies. But the growth trajectory should be fine, give or take.
Do you think the oil sector perhaps needs a bailout, given what has happened? No one saw this coming at this pace, but we knew it was going to happen at some point. But I don't think anyone expected it to happen this quickly. And given the challenges, especially the financial pressures that many of these oil companies are facing, especially the locals, Your thoughts about the concept of a bailout?
I think that's one I'll pretty much skip. The bailout all depends on whose funds it is.
Right.
If it is government funds and things,
Yeah.
I guess my first thought is no. There are many more things that the government should spend their funds on than bailing out people who've possibly made bad investments in that particular case. You also have to look that some of the deals are believed to have not been hedged at all. Almost anybody getting into these 2, 3, 4-year loan deals could have hedged a lot at higher prices. My understanding is some did, some didn't. Those who didn't, they made their bets and are going to have to live with their investment decisions.
Right. And in terms of the broader lessons for governments, you spoke about this concept of hedging. Many said, what happened to Nigeria? We didn't hedge. And many have played up the political considerations around that and why it could have been a difficult thing to do. But the reality has hit now, and we've seen that oil price taught everyone a big lesson that it can be very volatile. So your thoughts about the lessons going forward, how countries and companies should deal with this very, very important product?
Well, I'm going to answer that a little bit indirectly. As we know, since the rebasing of the gross domestic product of Nigeria and becoming the largest economy in Africa, we now believe that oil and gas and energy are only 10 to 15% of the GDP of the country. Let's see now, in this particular case, how the other 80, 85, 90% of the economy steps up to really drive the economy. It's not a direct answer to your hedging question, but oil and gas is, in theory, only that percentage of GDP in Nigeria. So,
right. But the point is, at this point, I mean, when you look at Nigeria, Angola, it is such an important component of government revenues. And some will suggest, at least in the medium term, it probably will stay like that way. But, and that's why I asked the question, should we begin to rethink how we deal with this very volatile product?
Rethinking things is absolutely fine, but I'm sorry I don't really have any recommendations on that.
Right.
Large international oil companies, by and large, don't hedge that because their investors know that's the inherent risk of their business. They know they're in for a ride on oil price and don't really expect those companies to try and smooth out results. Governments are different. Governments owe things to their people, so governments may have different decisions.
And that was Edward Voelcker, an energy and natural resources partner at KPMG